You are watching Daily Market Pulse. Good morning. This is your Daily Market Pulse briefing for Wednesday, April 9th, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Middle East ceasefire collapses as Iran closes the Strait of Hormuz, demanding crypto payments, while traders bet against everything in a coming 40 to 60% market crash. Here is the framework for today's briefing. Strait of Hormuz crisis. Iran closes critical oil route, demands crypto payments. Market crash warning. Veteran trader predicts 40 to 60% equity drawdown. Digital asset shift. Why stablecoins are replacing gold as the crisis hedge. Stagflation setup. Fed's limited options in rising inflation environment. Let's start with the geopolitical crisis that's reshaping global energy markets. The ceasefire between Israel and Iran has collapsed due to conflicting interpretations over Lebanon's inclusion in the peace deal. Iran has effectively closed the Strait of Hormuz to tankers without permission, demanding tolls in cryptocurrency. Iranian drone attacks targeted Saudi Arabia's east-west pipeline, while Israeli strikes continue in Lebanon. The Strait of Hormuz handles roughly 20% of global oil transit. This isn't just a supply disruption. It's forcing crypto adoption at the infrastructure level of international trade. When critical choke points start demanding cryptocurrency payments, it accelerates digital asset integration into real economic systems. Oil markets initially spiked but have stabilized at elevated levels. The bigger impact is the precedent being set for crypto-denominated trade settlements. Energy markets are pricing in a higher for longer, supply constraint scenario rather than temporary disruption. What to watch next? Monitor daily trade flow data through the Strait of Hormuz and track which cryptocurrencies Iran accepts for toll payments. This could become a template for other geopolitical choke points globally. Now let's examine the systemic risk warning that has veteran traders positioning defensively. Veteran trader Todd Horwitz is betting against equities, gold, and crude oil while going long grains and precious metals. He argues global markets are in a bubble comparable to 2001 and 2008, predicting a 40 to 60% equity drawdown driven by stagflation and excessive debt. When experienced traders with decades of market cycles start positioning for systemic collapse, it signals deep structural problems. The combination of record debt levels, weakening labor markets, and rising inflation creates a scenario where traditional Fed tools become ineffective. The current rally is being viewed as a final trap before major correction. Private credit markets are showing redemption issues similar to 2008. Consumer loan defaults on cars and mortgages are reaching concerning levels despite low unemployment headlines. What to watch next? Key technical level is the 200-day moving average on major indices. A breach would confirm the start of the predicted bear market. Also watch private credit firm redemption policies and corporate default rates. This brings us to a fundamental shift in how investors are thinking about crisis hedges. E.B. Tucker argues the U.S. financial system is approaching a controlled demolition to facilitate a Fed 2.0 centered on stablecoins and digital currency oversight. He warns against overconcentration in gold, suggesting focus should shift to digital defense and stablecoin infrastructure. If the Federal Reserve is engineering a controlled collapse to justify digital dollar integration, traditional precious metals hedges may underperform. The Strait of Hormuz crisis already shows real-world crypto adoption in critical trade infrastructure. Bitcoin faces short-term volatility from risk-off sentiment, but maintains medium-term thesis as inflation hedge. Gold may have already priced in its crisis premium. Stablecoin adoption is accelerating in international trade settlements. What to watch next? Monitor Fed policy language around digital currencies and CBDC development. Track stablecoin usage in international trade and energy settlements. Watch Bitcoin's correlation with traditional risk assets during market stress. Finally, let's examine why traditional monetary policy tools are losing effectiveness. The Federal Reserve's rate-cutting cycle is proving ineffective as mortgage rates remain elevated and consumer loan defaults surge. The economy shows signs of stagflation, with rising inflation, job losses, and record defaults on consumer loans despite official low unemployment figures. When traditional monetary policy tools stop working, it creates conditions for alternative financial systems to gain adoption. Stagflation historically leads to currency devaluation and drives demand for inflation-resistant assets. Bond markets are pricing in limited Fed effectiveness, consumer discretionary sectors showing stress, credit spreads widening in consumer lending, alternative assets gaining relative appeal as traditional hedges prove insufficient. What to watch next? Monitor the gap between Fed funds rate and consumer borrowing costs. Track consumer default trends across automotive, mortgage, and credit card segments. Watch for Fed policy pivots toward unconventional tools. So what's the bottom line from today's market pulse? We're seeing a dangerous convergence of geopolitical risk and systemic financial vulnerabilities. The Strait of Hormuz crisis isn't just about oil prices. It's accelerating the adoption of crypto in global trade settlements. Meanwhile, veteran traders are positioning for a major equity correction that could rival 2008. The traditional playbook of gold and bonds as safe havens is being challenged by digital assets and stablecoin infrastructure. For investors, this means preparing for higher volatility, watching key technical levels like the 200-day moving averages, and considering how digital assets fit into crisis hedging strategies. Thank you for watching today's briefing, and we'll be back tomorrow with your next Market Pulse.